The Australian housing markets are going gangbusters, and there are signs that this boom is going to be around for quite some time yet. But in today's podcast, I want to discuss with you 6 property trends that I believe are going to show themselves over the balance of 2021, and I'm also going to give you some ideas of how to take advantage of them. And in the second half of the podcast, I'm going to chat with property researcher John Lindeman, who is going to teach us how to profit from this stage of the growth cycle. Because if history repeats itself, many investors are not going to profit. In fact, they're going to lose some money. So at the end of today's show, you'll have a better idea and have more direction and certainty to take advantage of our property markets as they unfold for the balance of the year. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
It seems that we're in for a wild ride for our property markets in 2021. And in the second part of this podcast, I'm going to be having a chat with property researcher John Lindeman to show you how to take advantage of the opportunities. But if history's taught me anything, it's that we're going to be hit by an unexpected X factor, or some people call it a black swan event, something that's going to come out of the blue to undo the most reasoned property forecasts. It could be on the upside, as the first half of the year has been, or on the downside. But I would like to first share with you a number of property trends that I expect to happen for the balance of 2021. And the first one is that I believe property demand from home buyers is going to continue to be strong. Sure, currently home prices are surging around Australia, auction clearance remain high, and the media keeps reminding us we're in a property boom. But the result is emotions are running high at the moment, and fear of missing out is a common theme around our property markets. One of the leading indicators I watch carefully is finance approvals, housing approval, finance approvals, because these are what happens before people go off and buy their properties, and they're very strong at the moment. It's clear we're way out of the recession that we had just on a year ago when people thought that property markets were going to crash. We haven't fallen off the cliffs. Almost all the jobs that disappeared during COVID have returned, and our savings war chest will continue to fire the economy. You see, a household saved about $120 billion more than they normally would in the second half of last year, equivalent to 6% of the gross domestic product, partly because we weren't travelling overseas and social activities were curtailed. And what that really means is we've got this money now to spend, and we are spending it. Now, some of it's going to pay down debt, others is going to buy assets. We've already seen that in retail spending in our property markets. But today, with borrowing costs lower than they've ever been, and the reassurance that interest rates aren't going to rise for a number of years yet, and increasing confidence that we've got this virus thingy under control, even though it'll keep creeping back, it's likely that buyer demand is going to remain strong throughout the year. But this is a self-fulfilling prophecy, because as property values are increasing now, and as the media keeps reporting about how positive our property markets are, fear of missing out is going to continue to creep in on a whole new generation of people. Now, a second trend I want to make you aware of is that investors are coming back in the market and squeezing out first home buyers. So for the first half of the year, it was mainly first home buyers that were in the market. They were buoyed by many of the incentives being offered to them, but first home owner demand is now fading, partly because it's been brought forward due to incentives that had time-based to them, but also because there's increasing competition at the same level as investors are re-entering the property markets, and also affordability starting to become an issue and getting the deposits becoming an issue for first-home buyers. You see, typically investors compete for similar properties to first home buyers. Of course, over the last few years, investor lending has been at a very low level, at historically low levels, despite historically low interest rates. It's been partly due to banks making it a bit harder for investors than for first home buyers. The third trend I see happening is property values will continue to rise. Now, sure, it's not going to be at white-hot levels like it was for the first quarter of the year, so the rate of growth is slowing, but property price growth is nowhere near the end. We're still quite a way to go in this property cycle. Now, property cycles don't last a particular length of time. They're affected by consumer confidence and interest and finance availability, but this is still the beginning of what's going to be a very good 2021, and next year, 2022, is likely to remain a very, very strong year in property as well. Now, while many factors affect property values, the main drivers are really consumer confidence and low interest rates and economic growth and favourable supply and demand ratio. Now, there are multiple property markets around Australia. So while overall property values are going to remain strong through this year, certain segments are still going to suffer, particularly the inner city apartment towers and accommodation around our universities. And it's really unlikely that these segments are going to pick up for some time, as the value of these apartments are going to keep falling because buyers don't want to buy these sort of secondary properties. At the same time, rental markets are going to remain challenged for apartments, or particularly inner city apartments, but family-friendly apartments in the suburbs and houses, well, boy, they're renting quickly. Vacancy rates are low and rents are going up. Another trend that I believe is going to continue and in fact accelerate in 2021 is that people are going to pay a premium to be in the right neighbourhood. If coronavirus has taught us anything, it was the importance of living in the right property, in the right neighbourhood. A new coronavirus normal world means that people are going to pay a premium to be able to live, work, play within 20 minutes, drive, bike ride, walk from their home. They're going to look for such things as shopping, business services, education, community facilities, recreation, sporting resources, jobs even, within 20 minutes reach of where they live. Now, residents of these neighbourhoods have now come to appreciate the ability to be out and about, enjoying socialising, supporting local businesses, being involved in local schools, enjoying local parks. So, lifestyle neighbourhoods with amenity, with desirability, aspirational suburbs, they're going to outperform. And the people who can afford to live in these areas are the ones who've done well through COVID, who've got job security, who've got multiple streams of income. So an important trend moving forward is that people will pay a premium to be in the right neighbourhoods. And going along with that, another critical trend for the balance of this year, but it's actually been an ongoing trend for decades, is that more expensive properties are going to outperform. Now, while the current property cycle was initially characterised by all segments of the market rising, well, other than inner city high-rise apartments, now the high end of the market is leading growth in property values. And that's started a couple of months ago and has continued on. And if you've been reading my blogs on Property Update, where I can show the charts that I can't show in a podcast, you'll see that over the last decade, and it happened the decade before and the decade before, the more affluent areas, the higher end of the market, the more expensive end of the market, has outperformed with regard to capital growth. And another trend that I've discussed in previous podcasts, but I've got to mention because I'm telling you how these trends are important today, is that 2021 is going to be a year of upgraders. The current property and economic environment, plus the scars left on many of us after the year of COVID-related lockdowns, has meant many Australians are looking to upgrade their lifestyle. Many tenants are no longer happy to live in small, dingy apartments. And with the oversupply of rental apartments available in many areas of apartments, not houses, a lot of tenants are taking the opportunity to upgrade their apartments. As I said, this is going to be a year of upgraders. Other tenants who've managed to save a deposit are taking advantage of incentives, and they're becoming first-home buyers. With record low interest rates and surging property markets, many existing homeowners are upgrading their accommodation to larger homes in better neighbourhoods. In fact, a recent survey suggested 1 in 3 homeowners are looking to sell their home in the next 5 years. Now, while a small group of homeowners have realised they can easily work remotely, they're upgrading their lifestyles. They're moving out of the big smoke to regional Australia. Now, more Australians are actually looking to upgrade their lifestyle by moving to better neighbourhoods within our capital cities. But as I mentioned, they like the thought of things that they like, the good things in life being just around the corner. And the other level of upgraders are baby boomers who are looking to upgrade their accommodation by moving out of their old, tired, large family homes that they don't need anymore, that the kids have moved out, into larger, family-friendly apartments or to townhouses where they've got separate accommodation but on smaller compact blocks. Most are not looking for sea change or tree change. They still want to live in the same 20-minute neighbourhoods that I mentioned earlier on, close to their family, close to their friends. So this is a time of upgrade. It's one of the things that's driving this property market, and eventually, as our cycle moves on and we open the borders, and I'm not sure when that's going to be, there'll be a whole new wave of people coming in, wanting to live here, wanting to invest, wanting to rent here. But in the meantime, as this market moves on, as happens every cycle, a whole generation of new investors is all going to come into the market. It's not too late, and in a moment I'm going to have a chat with John Lindeman as we discuss the opportunities, but also the landmines ahead, because you can't just buy any property. But it is a great time to take advantage of the current opportunities that the market's presenting. As I said, that not all properties are going to do well, but how do you decide where to invest, what to invest, and maybe you shouldn't be investing in your own backyard? You need more than a buyer's agent to give you advice, because they're biased to where they buy, where they live, what they know. And don't ever go to a buyer's agent who just flies in and flies out. They don't know the local area. They don't have the perspective that a local buyer's agent has got. Property strategists are very useful, but I believe you actually need somebody who can give you a holistic approach. And you can trust the team at Metropole to provide you with direction, with guidance and results. So whether you're a beginner or an experienced investor or a home buyer, it's times like this that you need an advisor who can take a holistic approach to your wealth creation. And that's what we offer you at Metropole. Go to metropole.com.au, have a look at the range of services my team provide, and I'd be happy to be part of your wealth creation journey, but it always starts with putting a strategic property plan together for you. It's bringing your future into the present so you can do something about it now. Then you may choose to use our buyer's agency or our wealth advisory or our financial planning services, property management, renovations or development. I look forward to being part of your ongoing wealth creation journey. The Australian housing market's going gangbusters, and there's signs that the boom is here for some time yet. But how do you profit from this current growth cycle? And it's probably not going to be as easy as it seems. So let's have a chat with leading property researcher John Lindeman, Director of Lindeman Reports, to get his thoughts. Welcome, John.
Hi, Michael, and hello, everyone. It's great to be here.
Now, John, in a recent blog, you quoted Warren Buffett's 2 famous rules that all property investors should adhere to. Maybe you could share those with us.
Well, Warren Buffett said there was one rule that every investor had to follow, and that was never to lose money. And the second rule was never to forget the first rule.
So I think that's an important thing to remember at this time when the media is full of good news stories and maybe less experienced people in the property market and the whole range of new investors, whole generation of new investors are going to get in, think, I can just buy anything, anywhere, and it's going to go up in value. That's not really the case, is it?
It certainly isn't, because property market performance can vary by city, region, suburb, or different types of property. So you've got to be careful to make sure you're buying in the right area and the right property at the right time.
Well, if history repeats itself, and it most likely will, some investors are going to lose money, even though the overall market's going up. So they're going to mess up Warren Buffett's rule number 1. But for those who get into the market, in the past, around 50% have sold up in the first 5 years. And of those who stay in the market, Australian Taxation Office statistics show that 82% never get past their first or second property. So most don't get the security, the financial security they're looking for in property. So, John, what do you think an investor should do? What should be going through their mind when they're interested in getting involved in this property cycle?
Well, I think the first thing is that the last buyers that will enter a particular market before prices peak stand to lose. So you've got to really make sure you're buying in markets where the growth is still to come. And while there's some areas that look as though they're peaking or shortly will be peaking, there are others that have still got a lot of growth potential left.
Well, what's happened over the last couple of years is interest rates have come down, and so there's lots of people who can now afford a property. But that may change, probably not for a little while, but it could well be later this year, next year. There are some macro-prudential controls that tweak things a bit, make it harder to get into the property market. You either need a bigger deposit or you've got to be able to prove serviceability at higher interest rates. But the other thing is with rising property values, even though you can service the loan, I can see a lot of first home buyer markets are going to be slowed down because of affordability, just the deposit gap.
That's right. And it's important that you measure markets not by the length of time that price growth has been occurring or by the amount of growth that's taken place, but by the types of buyers that are creating the demand. And, this whole boom started with first home buyers. We had a 50% rise in the number of buyers, and they're the ones that have, started the growth occurring. So that means they're probably going to be the first areas where growth will slow down and then stop.
Well, the other thing, of course, is it's brought forward a lot of demand. The grants, including home builder and government subsidies, stamp duty subsidies, has brought forward demand. And we always see after this, there's a bit of a vacuum at the other side.
There is a bit of a slowdown, and I think the last people who have bought it, when prices are at their peak, maybe overextended a bit, will find themselves in a little bit of trouble, because when you're buying your first home, you also then have to buy furniture and white goods and gardening equipment and so on. So there's a lot of other expenses that a first home purchase incurs, and that's where people, if they don't allow for those things, can get into trouble.
Yeah, they overcommit themselves. Of course, that's one of the reasons the government is encouraging first home buyers, because they know that it greases the wheels of industry. So, John, how do you know that a market that you're looking at investing in has still got plenty of growth potential left in the tank?
Well, in this particular buyer boom, I think what we're looking at is that, as I mentioned, the first home buyers leading that. And then what happens is it moves into other types of markets, such as upgraders. So people who have bought a first home years ago are starting to upgrade. And so we're starting to see growth occurring in those areas. And then I believe it'll move into the more well-established areas where older people will downsize as they retire, take the increased equity that they've got as a nest egg for retirement. So we haven't really seen it move into those markets yet.
Interestingly, there's a myth that property cycles last a particular length of time, or that there's a particular time between one boom and the next. I don't really subscribe to that. And in fact, I think this time around, John, because it's gotten out of the gate so quickly, it's boomed so quickly, it's very likely to be a shorter cycle than previous times.
I think it will be, but it also opens the floodgates, as you mentioned, to other types of buyers. I think that once this growth wave is sort of dissipated, investors will come back into the market, and so we'll see growth in different areas occurring as a result of that.
Well, property buyers come in different shapes and sizes. The first home buyers are in at the moment. Upgraders are now seeing the value of their home increase. And a lot of people feel after COVID, I deserve a change. I'm looking for something different. Often they're looking for a different type of accommodation. Millennials, I guess, they're also at the point where they're now at the stage of their life that they don't want to live in those high-rise apartment buildings. They're wanting family-friendly dwellings as they're moving into family formation age. So by looking at demographics, that's a great way of forecasting what's happening or what's likely to happen moving forward, John.
It is. And I think that the price growth that's occurred in the first home buyer areas encourages existing home buyers to then upgrade, to take advantage of that increased equity. They look at their financial situation, they're better off. And also, interest rates are lower than what they were when they first borrowed. So they can then say, let's find a better house in a more desirable area and upgrade.
Well, one of the things you mentioned a while ago is the lower interest rates being one of the factors driving this, but there's only so long this can go on for, and it's going to slow down because the impetus from the low interest rates is slowly working its way through the markets.
That's right. There is an affordability limit. So you go to the bank as a first-time buyer and they'll say, well, you can have 25% more than what you could have borrowed a year ago, but there's a limit to that, isn't there? There's only so much that the banks will lend any individual property purchaser. So there is an upper limit to this, and we'll get there, and then the market will slow down.
Now, if you look at the various demographic groups, and we know that the Bureau of Statistics divides us into 5 skill groups, skill levels 1 and 2, the people who got higher incomes, the academics, the doctors, the dentists, the professionals, they've done pretty well during the slowdown of 2020, and they've got usually multiple streams of income. They've got some shares, they've got property investments and other things. So as far as I can see moving forward, some people are still going to be able to afford to buy property, upgrade their homes. They've also got equity in their homes, which has increased considerably. So some areas are going to become more desirable for these people, and they can afford them. So it's a social challenge in some ways, but the divide between the rich and the average property owner seems to be likely to increase, John.
I think it will, and the price differential between first-home buyer areas and these well-established areas where upgraders and families live is likely to increase as well. And over time, our studies have shown that it's the well-established suburbs where families live that have the most stable and longest sort of continuous price growth of any areas in Australia.
Well, that makes sense when you consider that in those areas, there are people who bought their house 30, 40 years ago. They don't have a mortgage. There are people who bought their house 20 years ago and they've half paid off their mortgage. And there are some people who only bought recently. While in those new outer suburbs, most of the people have bought recently. Most of the people have overcommitted, as you said, because not just for the house, but because of all the other things that they're buying as well. So on that basis, I'd rather be buying in an area that's more stable, that's going to be less volatile when this cycle, and we're not suggesting it's going to finish tomorrow, but when this cycle eventually finishes, you want to be in one of those areas that's going to be stable. You're also going to want to own the sort of property that's going to be in continuous, strong demand as this cycle finishes off.
That's right. And those areas that we've talked about, they have the lowest long-term vacancy rates as well. So, there's always high demand for properties and people live in them a long time.
Well, living in a long time is another good point. If you think about it, a lot of people who are getting into property investment today, they're probably still going to work another 10, 15, 20 years. And a lot of them are buying properties that may already be 20, 30, 40 years old. So when they retire and they're going to want to spend the longest holiday they have living off their property portfolio, another 20, 30 years, you've got to end up owning the sort of property then that's going to see you through, that's going to be in continuous strong demand, that's going to be liked by tenants, that's not going to cost you too much. So it's not just what works now. You've really got to see property as a long-term investment.
That's right. And look at those areas where the prices have experienced the most growth conditions and price stability over long periods of time.
Well, John, we've both got different levels of research. You do much, much more research than me. But what we've noticed over time is that particularly closer to the CBD, capital growth in general has been stronger, and it has actually flattened out capital growth the further out from the CBD you go.
And there's a very simple reason for that too, Michael, and that is that the percentage of homes that, say, in better areas, which in Sydney might be those on the harbour or beachside or those with a good view, and then in Melbourne it might be areas, close to the CBD and the parks and gardens of the inner areas. Those in proportion will go down as more and more suburbs are created on the outskirts of the big cities. So they become progressively more scarce, and that's why prices tend to rise more in those areas.
Now, I can't draw it on a podcast, but I guess if you do a concentric circles, a little circle, the first 5 kilometres around the CBD and the next one 10 kilometres and 15 kilometres, each of those 5 kilometre radiuses contain lots more properties the further out you go, doesn't it? That's what you were saying.
Exactly. It's the scarcity factor, and that people are prepared to pay a lot more for a property with a view, or a property that's located, say, near the river or Bayside in Melbourne, areas that are more sought after. And the number of those in comparison to the total number of properties decreases, so they become harder to get and therefore they're more expensive.
But somebody's going to be listening to this, John, and thinking, last year's pandemic made us want to now desert the city life, relocate to the country. Has this actually happened?
Well, it was going to happen. I think a lot of people thought that they'd want to move, and I know that a lot of the people we talked to, especially from Melbourne, was saying, as soon as this is over, we're going to get out. We're going to move to Brisbane or, somewhere far away. But of course, once the pandemic and the lockdowns passed, the people have looked at their situation and said, but hang on, all our family and friends are here, our work is here, we don't really want to move, the footy's on, we can go to that, so let's stay where we are. So I think it's something that urge to relocate dissipated fairly quickly. And if you look at the CoreLogic price data, you now see that capital city growth has started to exceed regional house price growth everywhere except Melbourne. And that's only going to happen in Melbourne, I would say, very shortly.
That'll happen in due course in Melbourne too. So one of the things that pushed up property values in regional Australia was the supply and demand equation. It was a small group of people moved into regional areas. But the other thing was, John, people didn't move out of the regional areas as much as they would have normally, because why would you suddenly go to the big capital cities when you've got the safety of staying in your country town? So I agree with you that I believe the majority of people are still going to want to stay where the jobs are, where economic growth is. But that's also because that's where the higher paying jobs are, it's likely that capital values will keep increasing just because people's wages are going to be higher.
Yeah, we've done a long-term study and compared capital city house prices to those in regional areas. And back in the early 1900s, they were about equal. But over time, that the comparative price of a country property compared to a city one has decreased. And I think that trend will continue over the foreseeable future.
I remember that chart that you did that went way back to Federation, and it showed how in those days, in fact, big regional centres values were almost as high as in some of the capital cities. And if you drive past those, you'll actually see some beautiful old stately homes in the States that were popular in those days, but it's turned around, hasn't it?
It has, and some of those old towns, they've got magnificent town halls and beautiful old buildings, as you say, that were redolent of a past that had a lot more potential than what it does now. But most people want to live in cities, and all the people who come here from other countries over the years have come from highly urbanised countries, and so they want to live in capital cities.
Well, John, I'd like to address another issue at the moment. I know many people are wondering about it too. Why did so many banks, why did the economists, why did the analysts get their forecasts so wrong last year?
Well, the simple reason is that they were looking back in time to see, has there ever been a similar situation? And what they looked back to were things like the GFC and the Great Depression, which were economic and financial disasters. And I pointed out in one of my blogs, which I think is actually on your site, is about pandemics and property markets and panics.
Yes, it is.
And in that blog, that was March last year, I pointed out that it was not actually, this is not or has not been an economic and financial crisis like the GFC or the Great Depression. It's a social crisis. And the remedies for this were things like social distancing, wearing face masks, and even lockdowns. They were the ways in which this pandemic could be conquered. And of course, the government throwing masses of money at the pandemic helped a lot too. So the only time that I could see that we had a similar situation was the outbreak of the Spanish flu after the end of World War One. And what happened there was that property prices went up dramatically once the worst of the pandemic was over. So I said, this is likely to happen again. It's exactly what has happened, because we didn't have the problems economically and financially that other countries have had.
Interesting. So some of the people with long memories, like you, like me, like Dr. Andrew Wilson, and who are property focused rather than bank and economic focused, actually got it right last year. And that's why I love chatting with you regularly on this podcast. I love reading your blogs and republishing them on Property Update. So I look forward to having another chat with you again real soon. And let's see how we can take advantage of this property cycle. Thanks for your time, John.
That's a pleasure. Thanks, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Are you an optimist or a pessimist? Now, this is a really important question to consider in this week's mindset message, because pessimism is a recipe for failure. Now, I've often mentioned it in these sessions before that optimists are more successful in life, but there's science behind what I'm saying. A paper published by the University of Cologne in Germany in May 2015 said, well, they actually studied 68,000 Americans and Europeans, and they found that pessimism causes poverty. The study noted that pessimism makes you wary of trusting others, and I can follow that. It went on to argue that when you see people in a pessimistic light, untrustworthy, self-interested and deceitful, you're less willing to rely on others. Those in the study who are the most pessimistic, interestingly, actually not surprisingly, also happen to be the poorest. If you're wary of trusting others, you're likely to have lower income now and in the future, the study concluded. Conversely, those in the study who are optimistic and had a more trusting view of others had a higher income than the pessimists. You see, pessimists miss out on opportunities because they're less likely to ask for help and less likely to collaborate with others. I've just realised that no one succeeds on their own. I've written about this often. I've podcasted about this before too. You need a team of people around you. You need others who believe in your cause in order to succeed. It's virtually impossible to succeed on your own. The most successful self-made millionaires have dedicated a team of people around them. Think of Richard Branson or Elon Musk. Interestingly, they also happen to be the most optimistic people to work for. Their unbridled optimism infected everyone around them like a virus. So if you're a pessimist, you're literally sabotaging your life. You're pushing the very people you need away, and you're left with no choice but to rely on yourself. So my message in today's mindset moment is pessimism is a recipe for failure. If you are thinking pessimistically, you probably don't even realize it. Remember, we're all driving around with one foot on the accelerator, doing good things, and one on the brake. We've all got good habits, rich habits, and we've also all got some poor habits. So watch out the way you're thinking. And are you a glass half full or a glass half empty person? If you want to be successful in any area of your life, you've got to become optimistic, not pessimistic. I hope you got some benefit from my chat with John Lindeman today. And remember that bonus I mentioned a short while ago. If you want to go to podcastbonus.com.au, you can get a range of reports and ebooks. But if you did get some benefit from today's show, why not tell somebody else about it? Share the experience with others who'd also benefit from it. Tell them about the Michael Yardney podcast, or tell the world by leaving a review. Now, if you want to catch me in between these twice-weekly podcasts, just look for Michael Yardney on social media. But there's another way you can get exclusive information from me by joining my private Facebook group. Go to Facebook and look for the Property Update private Facebook group, because every day I leave some snippets, some information, some charts, some commentary, some thoughts that you won't see elsewhere. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?